Warren Buffett has spent a lifetime reading balance sheets, studying businesses, and analyzing markets across decades. Yet when you strip away the numbers, the models, and the headlines, his extraordinary success comes down to something far simpler. One rule. A rule he has never broken, no matter how tempting the opportunity or how loud the market noise became. And here's the paradox. This rule has nothing to do with finding the perfect stock, predicting the next crash, or spotting trends before everyone else. In fact, most investors already know it. They've heard it many times. But when emotions take over, fear, greed, impatience, that rule is often the first thing they abandon. Understanding why Buffett never does is where long-term investing truly begins. Most investors think of rules as instructions for action: when to buy, when to sell, when to rebalance or move to cash. Investing, in their minds, is about doing something at the right moment. The more active the rule, the more useful it feels. Warren Buffett's thinking runs in the opposite direction. His most important rule is not about action at all. It is about restraint, about knowing when not to act, even when the market is begging you to do something. He has often said that investing is not a game where the person with the highest IQ wins, but one where the person who avoids big mistakes survives. This is where most investors get confused. They spend years searching for brilliant moves while ignoring the damage caused by unnecessary ones. Buffett understands that long-term success is built less on spectacular decisions and more on quietly avoiding irreversible errors. But restraint only matters if you know what you're protecting. At the heart of Buffett's philosophy is a rule so simple it often gets overlooked. Never risk permanent loss of capital. Not temporary declines, not uncomfortable volatility, but permanent damage that cannot be repaired with time. For Buffett, this rule comes before returns, before growth, and before excitement. He has always drawn a clear line between volatility and real loss. Stock prices move for countless reasons: news, sentiment, fear, optimism. These fluctuations feel dangerous, but they are not the true risk. The real risk is owning a business that cannot recover, a company whose economics deteriorate beyond repair. Markets fluctuate. Strong businesses endure. Most investors reverse this logic. They panic when prices fall, even if the business remains sound. Or worse, they accept fragile businesses simply because prices are rising. Buffett sees price movement as noise and business durability as signal. This distinction is where most investors quietly fail. Buffett has never been bothered by volatility itself. Sharp price swings don't concern him if the underlying business remains strong. What he cannot tolerate is fragility, companies that depend on perfect conditions just to survive. In his view, temporary price declines are a normal part of owning productive assets, while weak business foundations are permanent threats. This is why Buffett thinks of investing as owning a business, not renting a ticker symbol. When you own a great business, daily price quotes become background noise. Cash flows continue, customers stay loyal. The business does what it has always done. When you're merely renting a ticker, every price movement feels personal, urgent, and dangerous. The challenge is psychological. Humans are wired to feel pain from losses immediately, even when nothing fundamental has changed. A falling price triggers fear long before any real damage occurs. Buffett trains himself to separate emotional discomfort from economic reality, which leads to how Buffett actually defines risk. On Wall Street, risk is usually reduced to numbers on a chart. Beta, volatility, correlations, and complex models are treated as precise measurements of danger. The more data involved, the more sophisticated the analysis appears. But Buffett has never found this approach convincing. To him, these tools describe price movement, not true risk. Buffett defines risk in much simpler terms: not understanding what you own. If you cannot clearly explain how a business makes money, what keeps competitors at bay, and why it will still matter years from now, the investment is risky, no matter how stable the stock price looks. Predicting the future is not required. Understanding the present is. This simplicity is deliberate. Complexity often creates false confidence, making investors believe risk has been engineered away. Buffett prefers clarity over precision, knowing that clear thinking prevents the mistakes models cannot. And this is why Buffett says no far more often than yes. One of Buffett's most overlooked strengths is how often he chooses not to invest. He passes on the vast majority of opportunities that come his way, including many that are perfectly good businesses. Not because they are bad, but because they are not right for him. This selective restraint is intentional, not cautious. Every investment carries an opportunity cost. Capital committed to one idea cannot be used elsewhere. Buffett understands that spreading attention too widely dilutes judgment. By saying no to most opportunities, he preserves focus for the few that truly meet his standards. Over time, this discipline compounds into an advantage few investors can match. In markets driven by constant motion, patience looks like inactivity. But for Buffett, restraint is a form of action. It protects capital, attention, and emotional energy. This is not about avoiding risk altogether, but about choosing where risk is worth taking. But saying no only works if you know your boundaries. Buffett enforces his most important rule by staying firmly inside his circle of competence. He does not need to understand everything. He only needs to understand a few things deeply. Within that circle, risks are visible, assumptions are clear, and surprises are less destructive. Outside it, even attractive returns can hide permanent dangers. He has never felt pressured to stretch into industries he doesn't understand, no matter how fast they are growing or how convincing the narrative sounds. For Buffett, ignorance is not a temporary gap to fill later. It is a warning sign to step away. Many investors do the opposite. They confuse popularity with safety and familiarity with understanding. This is often where the one rule gets broken. The fear of missing out pushes investors beyond their knowledge, exposing capital to risks they cannot see. Buffett resists this urge by design, not willpower, and nowhere is this temptation stronger than during market extremes. Buffett does not change his rule based on market conditions. In roaring bull markets, he applies the same discipline he uses during crashes. When prices rise rapidly, he becomes more cautious, not more confident. Euphoria can be just as dangerous as panic because it quietly lowers standards and encourages careless risk-taking. During market downturns, the rule works in reverse. While others panic at falling prices, Buffett focuses on whether the businesses he owns remain intact. If capital is not at risk of permanent loss, volatility becomes an opportunity rather than a threat. The rule provides stability when emotions are at their strongest. This emotional consistency is Buffett's real edge. He does not rely on predictions or reactions. He relies on principles that remain unchanged across cycles. By removing emotion from decision-making, he avoids the extremes that trap most investors, which explains why patience is not passive for Buffett. Time plays a quiet but powerful role in enforcing Buffett's rule. Long-term thinking creates distance from noise, urgency, and emotional decision-making. The longer the time horizon, the harder it becomes to justify reckless choices that could permanently damage capital. Time encourages patience, and patience reduces mistakes. Buffett does not try to accelerate results. He allows compounding to work alongside business quality. When strong businesses are held long enough, temporary setbacks fade while fundamentals assert themselves. Time reveals which decisions were sound and which were fragile. This is why Buffett views time as an ally, not a variable to control. Short-term thinking does the opposite. It compresses decision-making, magnifies fear, and tempts investors to trade durability for speed. Many violations of the rule happen not because investors lack knowledge, but because they lack patience. And this brings everything back to a mindset, not a tactic. Warren Buffett's one rule is not a constraint on growth. It is a philosophy of protection that makes growth possible. By putting the safety of capital first, he ensures that time and compounding are allowed to work without interruption. Survival, in his view, is not conservative. It is essential. Without it, even the best opportunities eventually disappear. This is why Buffett's success looks simple in hindsight. He avoids permanent mistakes, stays within what he understands, and lets strong businesses do the heavy lifting over long periods of time. The rule is quiet, patient, and often overlooked. At Wealth Surge, the goal is not to react faster than the market, but to think better than it. Because in the long run, protecting what you have is how you build what lasts.